what banks look for, mainly, changing a lot lately, but ultimately they want to see your ability to repay a loan, and then they want to see your ability or their ability to get their money back as quick as they can if you don't pay the loan. Okay. So obviously that's where they want the equity in the property, because if they have to sell it because you don't make your payments, they want to know they can get their money back.
So in a place like Casuarina, like the prices don't fluctuate so much, but say in Sydney where it's dropping steadily right now, would people in Sydney be struggling to put a pin in the doll? Because the market is changing so much.
It is, and obviously again that's where if lenders, based on their exposure to certain markets. So, for instance, in Brisbane at the moment, most cities actually, a couple of cities, there's a glut of units coming on the market. So certain banks may have been lending a lot to those complexes or those postcodes. So now their exposure to that market is high. So they require, if you want to go into a loan with them now, they'll require more deposit. So they may require, so usually it's say you need 20% deposit to avoid mortgage insurance. Some lenders will say, okay, if you want to buy that unit in that city, in that postcode, we need 30% deposit.
So they're making sure that you've got equity in that.
They're making sure that if they have to, those values drop and they need to get their money back, they've got 30% equity in there to get it out because their exposure. Exactly, the buffer. Okay. And so that's where lenders will all have their different restrictions on the postcodes, and when you say, some lenders will let you draw out up to 90% to use for something else or whatever. It'll really depend on the security, which is the property, and where it is postcode. And that stuff changes all.